Good morning, friends. Good morning, friends. Okay, let's continue with our discussion. In the previous session, we had just continued with discussion on relevant costing. We are almost done with the relevant costing part. Maybe one or two more problems, and then we move to the next area. So this relevant costing was part of the decision making area. In simple words, a cost is considered to be relevant if the amount changes between the alternative course of action. In that, we specifically learn about relevant cost of material, labor, captive consumption and usage of machine. When it comes to relevant cost of material, we saw in stock, out of stock. Out of stock relevant cost is replacement cost. In stock, fast moving, slow moving. Fast moving, replacement cost. Slow moving, can be sold, realizable value. Can be used as a substitute, cost of the substitute. Both option available, higher of the two. Then we saw relevant cost of labor, available, not available. Not available, relevant cost, wages payable. Available, labor can be busy or idle. If they are idle, can be terminated, cannot be terminated. If the labor can be terminated, relevant cost is wages payable. Cannot be terminated, relevant cost is 0. Similarly, can be substituted, cannot be substituted. Can be substituted, relevant cost is cost of the substitute. Cannot be substituted, lost contribution plus wages payable. Then we saw captive consumption has outside demand, no outside demand. If it has outside demand, lost revenue plus or minus change in cost, and if it does not have any outside demand, only the variable cost is considered. Then the last part we saw was usage of machine. Regularly used machine, difference between relevant cost. Irregular use machine, difference in resale value. This is what we had seen in the previous session. Let's come to question 25. Question 25. Diesel is engaged in manufacturing many chemical products. It is using many chemicals, some of which are fast moving, some are slow moving, and few are in non-moving category. Firm has a stock of 10 units. Guys, come here. There the AC will not be better. The AC will be better in the front rows. The firm has a stock of 10 units of one non-moving. The firm has a stock of 10 units of one non-moving toxic chemical. Its book value is 2,400, realizable value is 3,500, replacement cost is 4,200. One of the customer of the firm asks to supply 10 units of a product which needs all the 10 units of the non-moving chemical as an input. Other cost, overhead expenses, out of pocket expenses, labor cost, other material costs, labor force required will be deployed from among the permanent employees. The temporary deployment will not lead to any loss of contribution. Recommend the minimum price to be charged. Analyze with reason for the inclusion or exclusion of each of the cost. Advise the pricing policy to be followed in perfect competition. Go through the question. Okay, we are required to recommend the minimum price to be charged for this some special work which has come. One of the customer has asked for supply of a 10 units of some product which needs this non-moving toxic chemical. There is a non-moving toxic chemical. It has 10 units of this the firm has a stock of 10 units of the non-moving toxic chemical, and it has some book value, realizable value, replacement cost, everything is given. I need to use all these 10 units, recommend the minimum price, analyze with reason for the inclusion or exclusion of each of the cost associated. 1 and 2 is similar. I don't know why they asked us two separate question, because when I am calculating the minimum price, I will calculate the relevant cost. When I am calculating relevant cost, I will consider some items, I will exclude certain item. Only thing is, this makes it very clear that I need to give a justification for each of that. The only part which is clear is, you may have to write 2-3 lines about each of the adjustment, explaining why you are including something or why you are excluding, and if you are including, what are you including it. So some explanation may have to be given. I will not focus much on the explanation part, we will just try to calculate it. Third part is, advise a pricing policy to be followed in perfect competition. This is a allied question related to a chapter called as pricing decision. In pricing decision, we have something called as pricing policies, different pricing policies. So I will touch upon the solution to this, but this is an allied question related to that area. And we have seen exam questions where ICI picks one concept from chapter 2, one concept from chapter 4, one concept from chapter 6 and makes it as a single question. So they try to keep doing that. That is okay, perfectly fine. As long as you are aware of the concept, you will be in a position to answer it. Let's start. Working note 1, computation of minimum price to be charged, computation of minimum price to be charged, particulars calculation amount. Okay, there are multiple adjustments given in the question. One of the customer of the firm has asked to supply 10 units of a product which needs all the 10 units of the non-moving chemical as an input. So one of the raw material is this, and there are other expenses. One thing I can do is, I can do all my calculation for a single unit, or I do all my calculation for 10 units and then finally divide by 10. One of the approach you will have to follow, either everything is for 1 unit or everything is for all 10 units, because there are certain items like out of pocket expense which is given 50 per unit, you may have to convert into 10 units, or if you are writing per unit, then other things should be at a per unit level. So the first item is toxic chemical. Toxic chemical, that is the first raw material I will have to use. Toxic chemical, tell me which category does it fit into and what is the relevant cost? Slow moving, realizable value, slow moving item in stock, slow moving. I don't have an option of substitute and nothing is given in the question. Realizable value is the amount. So in explanation, in stock, you may have to write a detailed explanation from an exam point of view, maybe expand this explanation and then you will write it. In stock, slow moving, can be sold. In stock, slow moving, can be sold. Realizable value. In stock, slow moving, can be sold. Realizable value. Realizable value. The realizable value is given as 3500. I am writing 350. I am writing per unit number. 3500 by 10. I am doing all my calculation at a single unit level. 350 is the toxic chemical cost. The 3500 is the value for 10 units of raw material. So we just need one, we are calculating for only 1 unit as of now. I need all the 10 units, but I am doing my calculation for 1 unit. So we are divided by 10, 350. Allocated overhead expenses. Allocated overhead expenses, that is the next item they have given. Allocated overhead expenses. How much is relevant? How much is relevant in this? Allocated, apportioned, general, corporate, distributed, all are irrelevant. All are irrelevant. What is allocated is maybe an expense is incurred at some corporate office and they are distributing a part of an expense to me, or maybe even the whole expense is distributed, but generally the decision being undertaken and this overhead expense being distributed has no linkage. There is no linkage with this production of this product. So these are generally considered to be irrelevant unless they make it very clear saying that variable overhead. If they use the word variable overhead, it is relevant. If they use the word specific overhead, it is relevant. If they use the word avoidable overhead, it is relevant. If they use the word discretionary overhead, it is relevant. But all other scenario, committed overheads, allocated overheads, apportioned overheads, general overheads, corporate overheads, fixed overheads, all these are irrelevant in nature. So allocated overheads irrelevant. 0. Allocated overheads irrelevant. Out of pocket expenses. Out of pocket expenses relevant, irrelevant? Ideally looks to be relevant. This is an amount which I may have to incur. It makes it very clear. Out of pocket expenses basically amount. See, there are certain expenses which are not out of pocket in nature. Basically you don't pay any money for that, but still they can also be relevant. Example, notional rent. Notional rent is not an out of pocket expense. What is an out of pocket expenses? Which involves any payment to an outsider. Out of pocket expense is basically something which involves a payment to an outsider. An opposite of this is a notional cost. An example is interest on own capital, which you may or may not pay, or rent on own building, or salary to the own person, the proprietor, salary of proprietor. All this may or may not be paid, but technically they are still relevant. Okay, for decision making they can become relevant depending on the opportunity cost principle. Depending on the opportunity cost principle, but out of pocket expenses are fully relevant because this will involve payment to outsider, or there is going to be an outflow of money. Outflow of money relevant. 50. Labor cost, some explanation is there below. Read that and let me know. Labor cost, there is an explanation given below. Labor is available, idle and cannot be terminated. There is no assumption also, the word permanent is used there. The word permanent is used there. So cannot be terminated. Why it is idle is if they were busy, when you do a temporary deployment, it will lead to loss of contribution. If they were busy, it will lead to loss of contribution. The temporary deployment will not lead to any loss of contribution. So available, idle and cannot be terminated. Available, idle and cannot be terminated. If there was no extra note, we would have taken the entire labor cost to be relevant. We would have taken the entire labor cost to be relevant. Available, idle and cannot be terminated. Other material cost. Other material cost. Any extra explanation? So to be incurred then. To be incurred. Relevant cost / minimum price. This is the minimum price based on financial factors. Relevant cost or minimum price. Relevant cost or minimum price 480. The minimum price for this order should be 480 per unit. The question anyway wanted the per unit number. Recommend with the minimum price to be charged to the customer without any loss to the firm, 480 rupees per unit. Analyze with reason for the inclusion or exclusion is an explanation you will have to give to every item. We have written a small explanation in that calculation column. Advise a pricing policy to be followed by diesel in perfect competition. I will discuss this in detail later on. But perfect competition is basically, there are multiple forms of market. There is a monopoly market, there is a duopoly market, there is a oligopoly market. Perfect competition is basically a scenario where you have how many buyers, sellers? What is the situation for buyers and sellers? Any idea, do you remember? Not equal. Large number of buyers and sellers. There will be a lot of buyers and sellers. So there is going to be intense competition in the industry. So when there is too much of competition in the industry, the pricing is basically something called as market driven pricing. The market will determine the pricing. In short, in perfect competition, what they say is there is no pricing policy needed. You need not have any policy. You enter the market, your price will be in line with what the industry is charging. Your price will be in line with what this industry is charging. This is also known as going rate pricing. All of this we'll discuss later on when I go to the pricing decision chapter. There is something called as going rate pricing. Going rate is basically the average rate of the industry. The average rate of the industry. So this is going to be market driven. Technically, I don't have any policy. Technically, I don't have any pricing policy in case of perfect competition. So the price is 480. Explanation on each of the item is given. I don't expect you to give such a detailed explanation, but 2-3 lines of explanation may have to be written if they specifically ask for it. This question has specifically asked for that. Under perfect competition, diesel can have no pricing policy of its own. Here sellers are price takers. It cannot increase its price beyond the current market price. So it's mostly market driven, whatever the market is charging, technically called as going rate pricing. Firm can only decide the quantity to sell and continue to produce as long as it is able to recover the marginal cost. It can adopt the going rate pricing method. Going rate is basically the average pricing for the industry. It's the average pricing for the industry. Clear? Any doubts on this? I'll touch upon in detail later on. The focus was just to do it on the relevant costing side. Just give me a minute. Okay, go through 26 and I want you to attempt it. Go through 26 and I want you to attempt the relevant costing part. Go through the question, start doing calculation. I could have left it as homework as well. Start doing it, go through the question and start attempting it. The only place where there could be a challenge is labor, but everything else should be fairly simple. Start doing it. give it a try. Another minute and then I'll start discussing this. Okay, the first item is interest cost, which is relevant in nature because I'll have to take a overdraft for this. I'll have to take a overdraft to do the work. 5 lakh into 10% into 3 by 12. 3 months is the contract tenor. 12,500 is the interest cost. Material in stock, slow moving in stock, which is of not immediate use. So, slow moving, realizable value. You have you need 3000 kg and the price at which it can be sold is 250. So, 3000 into 250, 7,50,000. Labor, we have two options and the relevant cost is going to be lower of the two options. It's only in the material where both options were there. It was because you can either decide to use it as a substitute or you can decide to sell it. That's a choice you will take and you will obviously take a choice which gives you a higher benefit. Here I will take a choice which is of lower cost. One, I can go for using the existing employees. Totally I need 2000 and they are saying 5 employees would be needed from other department. They would totally divide 2000 hours. Cost of labor is 300. Since the working hours have been diverted, the production in other departments cannot be. So, it is labor available, busy and cannot be substituted. You will lose a contribution of 1 lakh. Normal understanding is in this 1 lakh they would have deducted the labor cost. They would have subtracted the labor cost. So, lost contribution plus wages payable. So, lost contribution plus wages payable, which is lost contribution is 1 lakh given in the question. Wages payable is number of hours is 2000 hours into 300 rupees, 2000 into 300, 7 lakh. Or the other option I have is I can go for recruitment or I can go for outsourcing. In outsourcing I will incur 6,25,000. In outsourcing I will incur 6,25,000. I will obviously choose the lower one. So, this is going to be 6,25,000. I will end up outsourcing this work. I will not affect the existing employees, because if I affect the existing employee, they will lose 1 lakh rupee of contribution and I have to pay them 6 lakh. So, put together 7 lakh is an unnecessary cost. 7 lakh or 6 lakh 25, the company will choose the outsourcing option. The company will choose the outsourcing option. So, labor is 6 lakh 25,000. Overtime payment to inspection supervisor who checks the final product, this would be incurred irrespective of whether it is in-house or outsourcing, and this is an extra cost. Overtime is an extra cost, incremental, so relevant 25,000, incremental relevant. Then machine X, I need to use this machine. The depreciation of the existing machine is 40,000. The variable operating cost for the 3-month period is 3 lakh. At present, it is operating at full capacity. By diverting it exclusively for the special project, the company would incur a loss of contribution of 1 lakh for the 3-month period. So, it is a regularly used machine. The relevant cost is difference in replacement cost, but the problem is I do not think so there is a choice of buying it. I do not think the question has given me a choice of purchasing this asset, or maybe money is not available, it could be either reason. So, what I am forced to do is, it is like this: labor available, busy and cannot be substituted, machinery available, busy on some other work and cannot be substituted. So, if you want to take it from there and use it here, use it. Lost contribution plus variable cost, lost contribution plus variable cost, and if in that contribution that variable cost was not subtracted, I need not add it back. If it was not subtracted, I need not add it back. Normal understanding is this 1 lakh would have been post subtraction of 3 lakh. Depreciation is an irrelevant number, it is a fixed cost. Depreciation is an irrelevant number, it is a fixed cost. It would be incurred for this project or it would be incurred for some other project. Even the variable cost is also irrelevant number only. Variable cost would be incurred for this project or for some other work. But the only thing is the contribution given should not have subtracted the variable cost. It did not subtract the depreciation. Contribution will not be after subtracting depreciation. If contribution, let us assume they had given the word profit here, then technically you will have to add back the variable cost as well as the fixed cost, because in profit they would have subtracted the depreciation, they would have subtracted it. Here at least my understanding is in contribution depreciation is not subtracted, but variable cost is subtracted. So, machinery available, busy and cannot be purchased, I will use it, cannot be purchased as the word. I cannot buy this in the market, I cannot buy this in the market. Lost contribution plus variable cost, lost contribution plus variable cost. It had a contribution of 1 lakh, variable cost of 3 lakh. Lost contribution plus variable cost, 4 lakh rupee. Lost contribution plus variable cost. Clear? Lost contribution plus variable cost, 4 lakh is what machine X relevant cost is. Admin overhead, how much is relevant? 10,000. Incremental cost 10,000, that alone is relevant, that alone is relevant. Total relevant cost, okay, looks to be an acceptable from a financial point of view, looks to be an acceptable project from a financial point of view, because I think we have received an offer for 20 lakhs. So, from a financial point of view, go ahead and accept this, because we are making a profit of 177,500. We are making a profit of 1,77,500. From a financial point of view, it looks to be a perfectly fine decision. I will write the non-financial factors. I think the solution does not have any non-financial factor. That is what I remember in ICA solution, but I will tell you certain non-financial factors which can come here. when I'm taking up this contract, somewhere this machinery X1, you are diverting it from some other work which leads to a loss of contribution of 1 lakh rupee. That is okay. But because you are losing that contract, whatever that other contract is there a possibility of future impact because of that? Because you are losing some contract. This machinery was to be used on some other contract. Let's assume it was to be used for a big customer, an important critical customer. You cannot divert it. If it was for a critical customer, even if this project is viable, it makes more money, you will have to compromise with a lesser amount of money, because if it's a critical customer and you shift it, next time it can lead to issues for us. So impact of loss of sales on goodwill, future revenues, goodwill/future revenues due to usage of machinery for special project, possibility of future revenues from this new customer, possibility of future revenues from this new customer, possibility of future revenues from this new customer, impact of lower priced special order, impact of lower priced special order on pricing with other customers, So if you are keeping this lesser, is there a possibility that your other customers will start questioning you? They may come back saying that you have given a special pricing. So is there a possibility of that impacting or not? We need to see. I think these are the broader points I find. I don't think the solution had any points here. Nothing was given in the solution by ICI. But anyway, any question you do, you think about financial and non-financial factor. Wherever you can write some non-financial factors, please keep writing them. What we saw was a domestic order. Let's look at 27, which is an export order. There's nothing much to be done on the calculation front, so I'll quickly discuss the question and then I discuss the non-financial factor. N2CO is the manufacturer and supplier of firefighting and safety equipment for industrial use and follows the international quality standard and uses the high grade raw material. It is a fast growing brand that protects millions of people across India every single day. N2 has been offered a bid for a prospective export contract for 20,000 commercial fire extinguisher with following specification from USA buyer and the delivery term. So it is for 20,000 commercial fire extinguisher from USA. It's an export contract. N2 is exporting for the first time. The price computation per fire extinguisher is as follows. Direct material, all these are direct material, circle part, necking part, bottom part, everything put together 1,500. Direct labor, leakage testing, variable overheads, export clearance charges, fixed overhead, total cost, add markup, price is 2178. This is a calculation. They were having a profit of 10% on cost. USD to INR is 67. Price in US dollar is 32.51. So I told the export customer that I want to fix a price of 32.51. He has asked for a price of 28.5. US dollar 28.5. Analyze whether it's worth accepting USD 28.5 considering other factors. other factor. First let's look at the financial angle and then I'll come to the non-financial angle. No extra explanation is there in the question about any of the item. So rule is simple, all variable cost will be relevant, all fixed cost will be irrelevant. So entire part is relevant. This is direct material. Direct material is a variable expense, so the entire 1500 is relevant. Direct labor is a variable cost, looks to be relevant. Leakage testing, you can make assumption if you want, but to me it looks more like a variable cost, so again will be relevant. Variable overheads again would be relevant. Export clearance charges again would be relevant. Only irrelevant item is fixed overheads of 100. Only irrelevant item is fixed overheads of 100. They have not given anything extra in the question. If they had given something extra, I would have analyzed it that way, but nothing extra has been given in the question. General rule is all variable costs are relevant unless provided otherwise, all fixed costs are irrelevant unless provided otherwise. Let's do financial analysis of the export order. Financial analysis of the export order, question 27. Financial analysis of the export order. Particulars and amount, there is no major calculation here. Particulars and amount. Direct material 1500, direct material 1500. You can write even a single entry also, it's fine. Direct labor 80, direct material 1500, direct labor 80. Leakage testing 50. Variable overheads, export clearance and fixed overhead. Variable overheads is relevant, export clearance is relevant, fixed overheads is irrelevant. Fixed overheads is irrelevant. Relevant cost slash minimum price in INR. Relevant cost slash minimum price in INR. Relevant cost slash minimum. I am not bothered about the markup and all, that is not anyway comes into analysis, because relevant costing basically assumes zero profit. It will only give you the minimum price. It's up to you whether you want to increase that price. 1880. This is in INR. I'll convert this into US dollar. Some exchange rate is given in the question. I'll convert this into US dollar. Exchange rate is given in the problem. I think the exchange rate is 67. So divide by 67. 28.06 should be the minimum price in dollars. 28.06 should be the minimum price in US dollar. Minimum price in US dollar. The supplier is ready to give it as 28.5. So financially at least it looks profitable. Profit in USD per unit. Profit in US dollar per unit. In US dollar per unit. 28.5 minus 28.06, $0.44. $0.44 profit in US dollar. Profit for I think 20,000 pieces is the contract, again in US dollar, 8,800. So I'll earn $8,800 from this contract. $8,800 would be earned from this contract. So from a financial point of view, you'll have to write it like this. From a financial point of view, the company can go ahead, with this export order, however it should consider following additional factors. Okay, it's going to be an export contract, a special contract which I am trying to get into it. I'll talk about the points which are there in the ICA solution itself. Apart from this, any other point can also come. I think one of the point they are talking about is on buyer credit worthiness. They are talking about an element called as buyer credit worthiness. It becomes slightly more trickier in an export transaction. In a home transaction, it's easy to identify whether the buyer is credit worthy or not. When you are dealing with an export customer, it becomes more challenging. So you will have to analyze on buyer's credit worthiness and then take a call, because if the buyer credit worthiness is not there, if the buyer is not credit worthy, or if he defaults on this payment in the end, it can lead to a lot of challenges for the company. Because it's an export contract, there can be a lot of statutory compliance angle also coming in. You may have to comply with not only India's rules and regulation, you may also have to comply with USA's rules and regulation. Whatever rules and regulations are there, so you'll have to comply with their rules and regulation. So do you have the ability to comply with it? If you don't have the ability, you may have to recruit people. If you are recruiting extra people, are you going to incur extra cost, or are you going to appoint some consultant? Because if you appoint a consultant also, there is a possibility of an extra cost which is coming in. When it comes to buyer credit worthiness, we also have something called as ECGC cover. You can go for an export credit insurance, but if you take that insurance, there is also an allied cost associated with it. So you will have to take care of the cost side. Also, I think it talks about some documentation angle also. You need to have proper documentation, and for an export transaction, there are need for multiple levels of documentation to be maintained. So you will have to ensure that those documentation are in place. Because if those documentation are not in place, it can lead to again challenges. And then I think finally it talks about your delivery terms and other thing. Make it very clear to your other party that when the product is to be delivered, because if the delivery terms are not properly decided, it can lead to that you may have to, either you are not able to deliver as per the customer expectation. If you are not able to deliver, he may reject the consignment, or there could be a challenge of getting future orders from this customer. So understand on that angle as well. Let's look at what is there in ICA solution. Just give me a minute. Statutory compliances, knowledge of foreign laws, export documentation, inspection compliances, third party audit, no child labor certificate. This is an extremely important certificate. Many of the export orders get rejected if the certificate is not there. There are audits which are taken care by them. You will see one of a related question in an area called as ethical concerns in the same chapter. We have an area called as ethical concerns. There you are going to discuss about this. So I'll have to ensure that foreign laws knowledge is there, export documentation is in place, inspection are done, third party audits will happen, no child labor certificate needs to be done. Buyer credit worthiness, credit check on importer, ECGC cover, private party. You can ask for letter of credit or 100% advance. A letter of credit is basically an instrument which the customer gives to the supplier. In case on the due date, customer is not able to make the payment, the banker of the customer is forced to make the payment. The banker of the customer would be asked to make this payment. For this, the banker initially charges an LC commission. So that's why he gives this LC document. He takes that risk, saying that if my customer doesn't pay, I will pay for this, and because of this I am ready to give a credit. In a practical, LC is an important instrument. What happens is, whenever LC is there, you will be able to give credit to your customer. If LC is not there, you will ask for 100% advance payment. So LC if available, I will give credit, and the banker would be charging, the commission charges will obviously be lesser than the interest which you will pay, because what will happen is, if I am a customer, I have two choices. If I have to make immediate payment, I have to take a loan at the rate of 12%. Second option is, I can take an LC at the rate of 1% or 2%. So LC is normally at 1%, LC commission charges. So either you take LC at a lower rate, or you take a loan, provided the other party is okay with an LC. The other party is okay with an LC. Okay, I did not talk about this. Industry analysis. This is basically understanding whether there is a potential for future growth. Potential for future growth or ability to get future revenues. I did not discuss about this, so I am again telling you, I will not be remembering all those points which are there. I will try to write some of the relevant points. We are discussing the solution because once you go through the solution, you will understand it better. You will understand it better. This, whatever you see in the PPT, would be there in the summary material given to you. There is a summary material given to you. The summary material will have the PPT there, and the detailed solution will be there in your volume 1 or volume 2 of the book. So industry analysis, you can assess the competition. You can assess it through Porter's 5 forces model. You could have learnt about this in strategic management, where you look at multiple things: bargaining power of your customer, bargaining power of your supplier, how was the threat of substitutes, how is the competition, new competition going to come in, how is the existing competition there. So you do that analysis. Based on the analysis, you will be able to understand industry attractiveness. You will be able to understand industry attractiveness, and that can help you in knowing future growth potential and the expected revenues for future. Additional term, clarity on delivery terms, bank charges. If there are any bank charges which happens out of the transaction, who is going to bear the bank charges? Because see, the profit margin is already only $8,800. If on this I have to spend maybe $2,000, statutory compliances, I don't know, but I am just putting a number. I may have to spend $2,000 on statutory compliances. For analyzing the buyer credit worthiness, another $1,000 gone. On the industry analysis, another $1,000 gone. On bank charges, maybe another $2,000 gone. So my margin will keep coming down. The leftover profit will keep coming down. So that is why it's critical to understand those extra factors, and then based on that, you can finally decide your acceptance or rejection of the contract. I am not going to give an answer whether you have to accept or reject. That is not going to be given. I'll give you time to read this question solution also. Later on, question onwards, we will not read the solution. You can just go through the solution to understand how it is worded. But later on, I'll not be giving time for this. Later on, I think I'll just discuss the PPT. PPT will have the summary of this. Once you go through the PPT, broadly the points will be here. But maybe 1 or 2 questions you can read it. You can just read through it. Okay, we had started with relevant costing. Maybe now I'll just discuss about the chapter in detail. Just give me a minute. Okay, this was part of your chapter 5 on decision making. The reason for starting with relevant costing is very simple. Relevant costing becomes the basis for decision making. Any decision an organization takes has to be based on relevant cost. Any decision you take at your end has to be based on relevant costing. If you are aware of the relevant cost, based on that you will have to decide. For example, just to give another point, for a CA course, the fees is at the lower end. The amount of fees which you pay, all that is fine. But there can be sometimes opportunity cost, because maybe the course is more lengthier, it takes around 5 years time. It's possible that maybe in 2-3 years you would have done something else and started with your some profession. So basic thing is, whenever you are trying to evaluate any decision, you will have to keep into consideration the opportunity cost angle. There could be an opportunity cost or there could be an opportunity benefit that needs to be taken into consideration. There are going to be different types of decision you are going to learn. There will be special orders, there will be outsourcing decision, make or buy decision, there will be decision on shutting down a factory, there will be decision on indifference point, there will be decision on accepting a special order or expansion or termination, or whether to accept a strike by employees or not to accept a strike. So multiple types of decisions would be taken by an organization. Dropping a product line, further processing decision, special orders, make or buy decision, evaluation of multiple alternatives. All this, the crux or the basis becomes relevant costing. Relevant costing is basically going to tell as to how should I go about making a decision. Now what we are going to start now is, we are going to start with basics of marginal costing, which is extension of what you did at CA Inter. You have already done this at CA Inter level. It's just going to be an extension of what you did at CA Inter level. Now in basics, I'll basically discuss few of these formulae, which you could have learnt at inter level, but let's just discuss them and then we start discussing the problem. First, I'll discuss the format of marginal cost statement. I think most of you would be aware of it. Your format of marginal cost statement is, we have sales less, tell me the format, less variable cost, contribution less fixed cost, and profit. This is the format we follow: sales less variable cost, contribution less fixed cost, and profit. Particulars per unit total. Some of the items would be captured at per unit as well as total. Like your sales, you would like to capture the per unit selling price. Variable cost should be captured at a per unit level. Contribution should be captured at a per unit level. We should ideally not capture fixed cost at a per unit level. Even if the question gives you fixed cost per unit, it's a misleading information. Fixed cost per unit is a misleading information. We will convert that information into total fixed cost. We will convert that information into total fixed cost. Any problem you are solving, fixed cost per unit is a misleading information. We should ideally not look into that. Ideally, I should look into an information called as total fixed cost. Variable cost, total variable cost is not a useful information. I want variable cost per unit. Though in my calculation I may have to write the total variable cost because I have to calculate the total profit, but technically variable cost per unit is what I want and total fixed cost is what I want. These two are the useful information. Total variable cost and fixed cost per unit is misleading. Why this is critical is, if question tells you that variable cost increases by 10%, then the 10% increase will have to be applied at a per unit level. You don't look at the overall variable cost and say I'll increase 10%, because overall variable cost will also go up because of volume. If volume goes up, overall variable cost will go up. And if the question says fixed cost increases, that needs to be applied on total fixed cost. If you apply it on per unit, you will end up again making a mistake. So variable cost per unit change, total fixed cost overall change. Any change in variable cost represents a change in variable cost per unit. Any change in fixed cost represents a change in total fixed cost. Now, just give me a minute. Let's assume there are 10,000 units and 20,000 units. Sales 10,000 into 20, 20,000 into 20 less variable cost, contribution 10,000 into 5, 20,000 into 5, 150 and 3 lakh. Fixed cost is 1 lakh rupee. Profit is 50,000 and 2 lakh. Just an example, your sales has doubled, profit has gone up 4 times. Sales has doubled in this example, but profit has gone up 4 times. If I calculate net profit margin 25% and 50%, net profit margin from 25% has gone up to 50%. Normally, if somebody says profit margin has gone up, if profit margin has gone up, my mind will say either selling price has been increased or cost per unit has come down. Either you have increased the selling price or reduced the cost. Here none of them have happened. You have not reduced the cost. Technically fixed cost has not come down. You have also not reduced the variable cost. Variable cost per unit remain same. So practically this is an irrelevant ratio. Net profit margin is not a good ratio because it does not show the true profitability of a product. Net profit margin is not a good ratio, though we use it in a practical world, but net profit margin is not the right ratio because net profit margin has improved from 25 to 50. I ask the reason. Reason is neither increase in selling price nor reduction in variable cost per unit nor reduction in total fixed cost. It is only the benefits of economies of scale. You have doubled your sales, fixed cost did not double. Fixed cost did not double, sales has doubled, and that is showing a better profit margin. Whenever a better profit margin happens, my mind will say that either I have gone good on the sales side or I have gone good on the cost side. I have tried improving my efficiency. Nothing has happened. So practically organizations, when they are trying to make decision, don't look at this ratio called as net profit margin. Then what's the ratio they look at? They look at a ratio called as PVR, profit volume ratio, because this indicates the true profitability of a product. This indicates the true profitability of a product. I hope you remember the formula for your PVR. What's the formula for PVR? Contribution by sales into 100. 1,50,000 by 2 lakh. Profit margin is same 75%. Profit margin remains same 75%. Nothing has changed in the company. Profit margin continues to be 75%. Neither operations have got improved or operations have got deteriorated. Nothing have happened. Profit margin continues to be 75%. Net profit margin is not a relevant ratio at all. I am least bothered about the net profit margin. So practical world, lot of importance is paid to this, but when you are trying to make decision, NP margin is not what you should look at. You should look at practically PVR is more like gross profit margin. PVR is more like gross profit margin, because the understanding in trading account, whatever items you see, most of them would be variable expenses. Most of the direct expenses which you write in the trading account are variable in nature. Your indirect expenses which you write in the P&L are more like fixed in nature. There can be exceptions here and there, but broadly PVR would mimic the GP margin. PVR would mimic GP margin, and what organizations try to track is the GP margin. They try to track GP margin, understanding how is the GP margin moving for the company or your PVR. Okay, so PVR, one formula is contribution by sales. Another formula is contribution per unit by selling price. Contribution per unit by selling price, which in this case is your selling price was 20, contribution per unit, variable cost is 5, so contribution is 15. 15 by 20 into 100. 15 rupees is the contribution divided by 20 rupees of selling price into 100. Another formula is change in profit. Change in profit by change in sales. change in profit divided by change in sales will give the same 75%. It will give the same 75%. I hope the formula is there. If not there, I will give you time to write. Change in profit by change in sales. Other formula is change in contribution by change in sales. Change in contribution divided by change in sales. Just give me a minute. Okay, yeah, the formula are there. PVR contribution by sales, contribution per unit by selling price, change in contribution by change in sales, change in profit by change in sales. There will be few more formulae for PVR. I will come to that as we proceed. So, we have discussed a little bit on profit volume ratio. Profit volume ratio is a superior ratio as compared to net profit margin. It is a superior ratio as compared to net profit margin. Net profit margin may not help me in decision making. It may not help us in decision making. Okay. Now comes the break even point and margin of safety. It is a very simple formula. Now listen. Break even point plus margin of safety. Break even point is basically the sales at which you make no profit, no loss. Margin of safety contributes towards profits of the company. Margin of safety contributes towards the profit of the company. This is called as total sales. Break even point plus margin of safety is equal to total sales. Fixed cost plus profit, fixed cost plus profit is equal to, look at the marginal cost statement and let me know what will be fixed cost plus profit. What will be fixed cost plus profit? It is contribution. Fixed cost plus profit is technically contribution. Fixed cost plus profit is contribution. What is the formula for PVR? PVR is contribution sales. Sales goes this side. Sales into PVR is contribution. Sales into PVR is contribution. So listen, into PVR equal to contribution, into PVR equal to profit, into PVR equal to fixed cost. Now this equation technically gives you 10 to 15 different formulae. What is the formula for break even point? BEP into PVR is fixed cost. BEP into PVR is fixed cost. So BEP is equal to fixed cost divided by PVR. BEP is equal to fixed cost divided by PVR. I can also say BEP is equal to total sales minus margin of safety. Total sales minus margin of safety. Profit is equal to MOS into PVR. Profit is equal to contribution minus fixed cost. Multiple formulae can come. MOS is equal to profit divided by PVR. MOS is equal to profit divided by PVR. PVR is equal to contribution by sales. PVR is equal to profit by margin of safety. PVR is equal to fixed cost by break even point. PVR is equal to fixed cost by break even point. So you can keep interchanging this and keep writing different formulae from this. So you have different formula for PVR coming from this. The only change here is sometimes you will multiply with contribution per unit. Instead of multiplying with PVR, you can multiply with contribution per unit. When will you multiply with contribution per unit? Is if you have break even point in units, margin of safety in units, sales in units. Unit sold into contribution per unit is total contribution. Unit sold into contribution per unit is total contribution. Margin of safety in units into contribution per unit is profit. Margin of safety in units into contribution per unit is profit. Break even point in units into contribution per unit is fixed cost. Into contribution per unit is fixed cost. Write this equation. BEP plus MOS. BEP plus MOS equal to total sales. this contribution per unit you will write it later. BEP plus MOS is equal to total sales into PVR equal to into PVR equal to into PVR equal to. BEP plus MOS is total sales into PVR equal to fixed cost into PVR equal to profit into PVR equal to contribution. Into PVR equal to fixed cost, profit and contribution. Now this technically gives me two different formulae. One formula is for break even point and one formula is for margin of safety. Apart from that, it can give any number of formulae. Apart from this, these two things I wanted to discuss. One was your break even point, another one was margin of safety. So these two formulae comes from this place. There are other formulae for break even point. You can say break even point is total sales minus margin of safety. You can say break even point is equal to fixed cost by PVR. So you can arrive at multiple different ways to get to this number. Any doubts on this? Same thing you write again. BEP in units plus MOS in units is equal to units sold. BEP in units plus MOS in units is equal to units sold into contribution per unit into contribution per unit into contribution per unit equal to same thing, fixed cost, profit, contribution. BEP in units plus MOS in units is equal to units sold into contribution per unit is equal to fixed cost into contribution per unit is equal to profit into contribution per unit is equal to contribution. Clear? And sometimes you will get answer in units, you want the answer in rupees. For example, BEP in rupees is equal to BEP in units into selling price. If you have the data in units, multiply with selling price. If you have the data in rupees, divide by selling price. MOS in rupees is equal to MOS in units into selling price. Our MOS in units is equal to MOS in rupees divided by selling price. So that's a connecting part. So we are done with format, PVR, BEP, margin of safety. BEP and margin of safety discussion. BEP refers to the sales level at which company earns no profit and no loss. If expressed in units, it's called BEP. If expressed in rupees, we use the word break even sales. Different formula are there: fixed cost by contribution per unit, fixed cost divided by PVR, BEP in units into selling price. There's another formula which is not mentioned there. The another formula is total sales minus margin of safety. Total sales minus margin of safety will become the break even point. Margin of safety is basically the difference between the actual sales and break even sales. It basically contributes towards profits of the company. Whatever profits a company is making, that comes out of the margin of safety sale. In a practical world, you cannot say this is a break even sale, this is a margin of safety sale. There's no difference. These are just mathematical numbers. Just to explain that if you sell 5 lakh rupees, you will have no profit. Beyond 5 lakh only, you will start having profit. So that's just a calculation at your end. When you practically say, you cannot say this is a break even sale and this is a margin of safety sale. That is not possible. Profit by contribution per unit, profit by PVR, units into selling price, sales in rupees is BEP in rupees plus MOS in rupees. You add them, so you can subtract and get the other part. Okay. I'll discuss two more formulae: sales to achieve desired profit and profit at desired sales level. Balance things, we'll see it in a problem. When we do a question only, you'll understand it. Items like break even point for multiple products, indifference point, shutdown point, limiting factor, all this we'll discuss later. Now coming to sales to achieve desired profit. That is, the question will say I want to earn a profit of 10 lakhs, I want to earn a profit of 15 lakhs, 20 lakhs, something would be given in the question. Some number would be given in the question that they want so much profit. Now, PVR is equal to contribution by sales. Sales is equal to contribution by PVR. Sales is equal to contribution by PVR, where contribution is equal to fixed cost plus profit by PVR. Fixed cost plus profit by PVR. So, sales to achieve desired profit is equal to fixed cost plus desired profit by PVR. Fixed cost plus desired profit by PVR. This is the derivation of the formula. Your PVR is equal to contribution by sales. So, sales is equal to contribution by PVR, and contribution is nothing but fixed cost plus profit. Fixed cost plus profit. Profit is desired profit. You can divide by PVR, you can also divide by contribution per unit. You can divide by PVR. Whatever formula I have given till now, every formula the denominator can be two things, either PVR or contribution. For example, break even point, fixed cost by PVR or contribution per unit. Margin of safety, profit by PVR or contribution per unit. If you divide by PVR, you get the answer in rupees. If you divide by contribution per unit, you get the answer in units. You get the answer in units. Clear? Any doubts on this? So, sales to achieve desired profit is equal to fixed cost plus desired profit divided by PVR slash contribution per unit. PVR slash contribution per unit. And the last part is profit at given sales. The question can mention some sale number and they would want you to calculate profit. They would want you to calculate profit. Profit is nothing but contribution minus fixed cost, and contribution is nothing but sales into PVR. Sales into PVR. So, whatever sales would be given in the question, multiply that with the PVR or contribution per unit. If you have the sales in units, multiply with contribution per unit. If you have the sales in rupees, multiply with PVR. Get the contribution, subtract the fixed cost, and you will get to know the profit which the organization is making. So, sales to achieve desired profit, target profit plus total fixed cost by PVR or contribution per unit. Profit at sales level is sales into PVR minus total fixed cost. For BP MOS sales, the answer would be in rupees if the denominator is PVR, and the answer would be in units if the denominator is contribution per unit. There are few more things to be discussed like multiple products. We will come to that as we proceed. Let us come to question 1, page 314, page 314, question 1. The simple problem just to get used to the basics. ABC has given the following data: selling price per unit, material cost, labor cost, variable overhead, fixed overhead, units sold, units produced. Find out. I would have asked multiple things. We'll just go one by one. We'll start going one by one. First is a marginal costing income statement. So, let's prepare that, and then we'll see whatever is the requirement. We'll do one by one. Go through the problem. This chapter is heavy on the practical part. The theory oriented discussion will be limited on this chapter. Balance all chapters. I think major discussion will be on the theory side, or mix of theory and practical. I think one more chapter which is fully practical oriented would be standard cost, transfer pricing and standard costing. These three chapters has more of practical oriented areas, but otherwise all chapters will have theory and practical discussion together. Okay, let's prepare a marginal costing income statement. Question 1, working note 1, marginal costing statement. Particulars per unit and total. particulars per unit and total. Now, the marginal costing income statement would be for units sold, not for units produced. The company has produced more, but what matters to us is how much they have sold, because your profit would be made only on the units which are sold. So, total in bracket 5000 units, total in bracket 5000 units, in bracket 5000 units. We make the statement for units sold. For units sold, sales less variable cost, contribution less fixed cost and profit, sales less variable cost, contribution less fixed cost and profit, selling price given in the question is 20 rupees into 5000. Selling price is 20 rupees into 5000, 20 into 5000, variable cost is direct material is a variable cost, direct labor is also variable cost, variable overhead is also variable cost. Material and labor are considered to be a variable cost. 12 rupees, 60,000, 12 and 60,000, 8 and 40,000, contribution 8 rupees and 40,000, fixed cost is 20,000, profit is 20,000. Fixed cost is 20,000, profit is 20,000. Clear? PV ratio, that's next requirement. PV ratio, you can use any of the formula you want to. PVR is equal to contribution per unit by selling price into 100. PVR is equal to contribution per unit divided by selling price into 100. You can also use overall contribution. 8 by 20 into 100, 40%. 8 by 20 into 100, 40%. Next is break-even sales and break-even point. Let's assume question uses the word break-even point. Then also you'll have to do both rupees and units, unless specifically they say just do units or rupees. Here anyway both have been asked in the question. BEP in units is equal to the formula comes out of that equation which I said, fixed cost by contribution per unit. Fixed cost by contribution per unit. Fixed cost by contribution per unit. $20,000 by 8. Fixed cost by contribution per unit. 20,000 divided by 8. 2,500 units. Then BEP in rupees. BEP in rupees, which is BEP in units into selling price. I'm just doing this question just to revise what you could have done at CA Inter. BEP in units into selling price. 50,000 rupees. Then margin of safety at a sale level of 1 lakh. They have asked for margin of safety. They have given the sales level. The margin of safety will keep changing based on the sale level, because if you have more sales, more can be margin of safety, lesser sales, lesser can be margin of safety. Break even point does not change based on the actual sale. So margin of safety is equal to total sales minus break even sales. Total sales minus break even sales. Total sales minus break even sales. Sales given in this part is 1 lakh. Originally also it was 1 lakh. They can change anywhere. They can make this time 1 lakh 50 also if they want. They can ask what is the margin of safety when the actual sales is 1 lakh 50,000. 1 lakh minus 50,000 rupees 50,000 are, I'll convert into units here itself. Rupees 50,000 are rupees 50,000. You'll have to do both units as well as rupees. Either you write it as a separate line item or you complete it here itself. Rupees 50,000 are divide by 20. 2,500 units divided by 20, 2,500 units. MOS is 50,000 or 2,500 units. Clear? Next, sales to earn. This is sales to achieve desired profit. Sales to earn profit of 5,000. Sales to earn profit of 5,000. This is sales to achieve desired profit. Sales to achieve desired profit. If you remember the formula, it is fine. Else you can prepare a marginal costing income statement. There also you will get the answer. Formula is desired profit plus fixed cost by PVR. You can even divide by contribution per unit. We can divide even by contribution per unit. Desired profit plus fixed cost by PVR. Rupees 62,500 or, can you divide by 20 and let me know, or I think or 3125 units. 62,500 or 3125 units. 62,500 or 3125 units. Clear? PV ratio, if the selling price is increased by 10%, there is a change in the selling price. So with that, what is the PV ratio is the requirement. What is the PV ratio is the requirement? If the selling price is increased by 10%, PVR is equal to contribution per unit by selling price into 100. Contribution per unit by selling price into 100. See, earlier the contribution was 20 minus 12. 20 minus 12. Now the selling price goes up by 10%. Selling price from 20 rupees will go up to 22. So it's 22 minus 12 divided by 22 into 100. 22 minus 12 divided by 22 into 100. Basically 10 by 22. How much? 45.45%. Contribution per unit by selling price. Your selling price goes up by 10%. So 20 becomes 22. Variable cost, nothing has been given in the question, so remains same. 22 minus 12 divided by 22. Profit when sales is 2 lakh. You will have to go back as per the original scenario. Okay, the PVR and all will be as per the original scenario. Whenever you do any rework, it's always an extension of the original scenario. Profit is equal to sales into PVR minus fixed cost. 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 It will be the original PVR, not the reworked PVR which you had done. Profit is 60,000. Sales into PVR minus fixed cost. Sales into PVR minus fixed cost. 2 lakh into 40% minus 20,000. If the fixed cost are 40,000, annual sales are at 60% margin of safety, calculate the rate of return on sales assuming an income tax level of 40%. If the fixed cost is 40,000, so originally it was 20,000, now they made it as 40,000. Annual sales are at 60% margin of safety. Annual sales are at 60% margin of safety, which indirectly mean break even point is 40%. Break even point is 40%. Rate of return on sales is nothing but rate of return on sales is equal to net profit by sales. Rate of return on sales is net profit by sales into 100. I can do two answers. One is pre-tax return, second is post-tax return, because there is some income tax return which they have given. So fixed cost is 40,000. Annual sales are at 60% margin of safety. So let's first capture some of the points. Point number A, break even point is equal to fixed cost by PVR. Break even point is equal to fixed cost by PVR. Fixed cost is 40,000. Fixed cost is 40,000. PVR as per the original scenario, because nothing is there in this part. PVR as per the original scenario is 40%. 1 lakh. Break even point is 1 lakh. Clear? Any doubts on this? Break even point is 1 lakh. MOS is equal to 60% of sales. MOS is equal to 60% of sales. I am currently operating at 60% margin of safety. Break even point is equal to 40% of sales. Break even point is equal to 40% of sales. Now this will help me in getting the actual sale number. This will help me in getting the actual sale number. 1 lakh is equal to 40% of sales. $2,50,000. Rate of return on sales is profit before tax by sales into 100, profit after tax by sales into 100. Basically, rate of return on sales is net profit margin, return on sales which is your net profit margin, which is the net profit margin. Next, ignoring the taxation for the time being, profit is equal to sales into PVR minus fixed cost. Profit is equal to sales into PVR, sales into PVR, 2,50,000 into 40%, 2,50,000 into 40%. Fixed cost for this part of the question is 40,000. Fixed cost for this part is 40,000. Profit is 60,000. Profit is 60,000. 2,50,000 into 40% minus 40,000. Okay, this is just for your quick calculation. It will work in all the questions, but if I had done it directly, you will not understand. BP 40% equal to fixed cost 40,000. Fixed cost is 40,000. BP is based on fixed cost. MOS 60%. MOS is based on profit. If 40% is 40,000, 60% will be 60,000. 40% is 40,000, which is your fixed cost. Profit will be 60%, which is 60,000. Profit will be 60%. Your break even point is based on fixed cost. Margin of safety is based on profit. Margin of safety is based on profit. So technically I could have done this. Your profit is going to be 60%. Fixed cost is 40%. So 40% is 40,000. 60% is 60,000. Overall 1 lakh is contribution. Overall contribution is 1 lakh. Based on that, overall sales is divided by 40%, 2,50,000. I could have done this way as well. Now, pre-tax rate of return. Pre-tax rate of return is equal to PBT by sales. PBT is what you have calculated, 60,000. Pre-tax rate of return, PBT by sales. PBT by sales. PBT is what we have calculated. 60,000, 2,50,000 into 100. 60,000 by 2,50,000 into 100. How much percentage? 24%. This is pre-tax rate of return. You can also calculate a post-tax rate of return because tax rate is given in this part. Post-tax rate of return on sales. The marginal costing income statement can only give you PBT, okay? Sales less variable cost, contribution less fixed cost, that profit is PBT. That profit is PBT. In fact, it can even be EBIT, okay? If you have not subtracted interest in the calculation, it will turn out to be EBIT, earnings before interest and tax. Post-tax rate of return. 36,000 by 2,50,000. 60,000 minus 40%. 60,000 minus 40%. Post-tax rate of return is 14.4%. Pre-tax was 24%. Post-tax is 14.4%. Any doubts on this? Okay, let's continue now. Let's come to part I. Sales to maintain the same profit. Friends, please. Guys, no discussion among yourself, please. Sales to maintain the same profit in case variable cost and fixed cost increase by 10%. And the last part is desired sales to maintain the same profit per unit with variable cost and fixed cost increase of 10%. So situation I want to maintain same profit. Situation J, I want to maintain same profit per unit. Same profit per unit. In both the scenario, variable cost and fixed cost is going up by 10%. So, particulars per unit total. Particulars per unit total 2 times. One is for situation 9, another one is for situation 10. Sales to maintain the same profit. Desired sales to maintain the same profit per unit. 2 situations are there. The original profit is 20,000. Situation I and situation J. Okay, let's come to situation I. Selling price will continue to be 20. Selling price will continue to be 20. Number of units may not be 5,000, it may have to go up. It may have to go up. So, I am not writing the overall number. I am not writing the overall number. The number of units, see the question has said, listen, sales to maintain the same profit in case the variable cost and fixed cost increase by 10%. Some question will say selling price to be fixed to maintain the same profit. Some question will use the word selling price, some question will use the word sales, some question will use the word unit sold. If they give unit sold is X, unit sold is X. If they give sales, again unit sold is X. If they give sales, the change in sales will happen because of unit sold. If they give selling price, then selling price will be taken as X. Selling price will be taken as X. So, 20X is the overall sales. 20X is the overall sales. Number of units is X. Number of units is X. Variable cost will go up by 10%. Any change in variable cost represents a change in variable cost per unit. So, 12 will become 13.2. 12 will become 13.2 and this will be 13.2x. 12 will become 13.2 and this will be 13.2x. Contribution is 6.8 and 6.8x. Contribution is 6.8 and 6.8x. Fixed cost is 22,000. 20,000 will go up by 10%. 20,000 will go up by 10%, 22,000. And this is 6.8x minus 22,000 is equal to, they wanted to maintain the same profit equal to 20,000. 6.8x minus 22,000 equal to 20,000. You will get an answer to X, that is the unit sold, and from there value of sales. 6.8x minus 22,000 is equal to 20,000. $42,000 divided by 6.8. 42,000 divided by 6.8. How many units? 61. And value of sales is 6176 into 20. 6176 into 20. $123,520. Okay. Coming to situation J, where they have said sales to maintain the same profit per unit, same profit per unit. Till this everything will be same. 20, 20x, 13.2, 13.2x, 6.8, 6.8x, minus 22,000. Minus 22,000. How much is the profit per unit now? 20,000 divided by 5,000, 4 per unit. In situation J, how many units sold we have taken? What is the unit sold number? Situation J, what have we taken as units sold? X. We have assumed it to be X. So it will be 6.8x minus 22,000 is equal to 4x. 4 is the profit per unit and number of units is X. 4 is the profit per unit and number of units is X. So 4x, 6.8x minus 22,000 is equal to 4x. 6.8x minus 22,000 is equal to 4x. Objective was to maintain profit per unit. Objective here was to maintain profit per unit. Value of sales is 7857 into 20, 157, 140. Clear? Any doubts on this? Okay, I'll come to question 2 then. VJ Limited makes and sells two products V and J. Budgeted selling price is 1800, J is 2160. Variable cost associated with producing and selling is 900 and 1800. Fixed production and selling cost is 88,000. Company has two production or sales option. V and J can be sold either in the ratio of 2 V's to 3 J's or in the ratio of 1 V to 2 J's. What will be the optimal mix and why? Go through the question first. Okay, I have two products V and J. Selling price data is given, variable cost data is given, that will give me the contribution per unit, fixed cost data is there. I have two options. Either I can sell in the ratio of 2:3, 2 V's to 3 J's, or I can sell in the ratio of 1:2. Now, if the problem had said that the company plans to sell 60,000 units, if at all they had mentioned something like this, what I would have done? 2:3, how many V, how many J, and what is the profit we make? 1:2, how many V, how many J, what is the profit we make? Whichever gives more profit, I can go ahead with that. If the problem says the company plans to sell 60,000 units, 1 lakh unit, 2 lakh units, some number if it was given. Unfortunately, they have not given a number. They have not mentioned how many units would you sell. Nothing is mentioned in the problem. If they had given any number saying that the company plans to sell 1 lakh units, it would have become fairly simple for us. 1 lakh in the ratio of 2:3 would have split. How much contribution from V, how much contribution from J, deduct fixed cost. Similarly, contribution from V, J and deduct fixed cost. Now, the problem has not mentioned that, but still they want us to calculate optimal mix and also give a reasoning. Now how will we find optimal mixes? We will calculate break-even sales for both alternative. We will calculate break-even sales for not both product, I am talking about both alternative. Whichever leads to early break-even, whichever leads to early break-even is a preferred choice, whichever leads to early break-even, because I am not able to distinguish in any other way. If that given me a volume number, I could have done it that way, but now what I will do is I will calculate the break-even sales. Whichever leads to early break-even is the preferred choice, So the two choices I have is, one choice is sell in the ratio of 2:3, another choice is to sell in the ratio of 1:2. It's not a choice between V and J. The question has not mentioned that the company is deciding whether to sell V or whether to sell J. That's not the choice we are making. We are required to make a choice whether it should be 2:3 or 1:2. I try coming to break-even point. Break-even point is fixed cost by contribution per unit. Fixed cost by contribution per unit or fixed cost by PVR. Fixed cost is 88,000. Contribution per unit is different for V, different for J. Contribution per unit is different for V, different for J. So I don't know what to write in the denominator now, because denominator says contribution per unit and we have two contribution per unit in the question. There is a contribution per unit for V, there is a contribution per unit for J. But I want to know what is the contribution of option 1 and option 2. What is option 1? 2:3 and option 2 is 1:2. I want to know the contribution of this and not the contribution of V and J. What is available in the question is the contribution of V and J. So kind of a tricky situation. This is called BEP for multiple products. This is called BEP for multiple products. For calculating BEP of multiple product, there are two ways of doing it. One, we go through something called as a weighted average PVR. Weighted average profit volume ratio. You will calculate the PVR of product 1, you will calculate the PVR of product 2 and then take a weighted average of that. Take a weighted average. How will you take weighted averages? Multiply with 2 and 3. Multiply with 2 and 3 and then take a weighted average. The weight composite PVR. Composite PVR are weighted. I'll give you time to write and all. If something is to be written, please understand. Weighted average PVR. This approach will be used if the sales mix ratio is for amount of sales. Question has mentioned the company plans to sell it in the ratio of 2:3, 2 V's to 3 J's. What is the selling price of V? So 2 V is 3,600, okay. 3 J is 3 into 2160 is how much? 3 into 2160 is. This, if you look at, is not the ratio of 2:3. If you look at this value, this is not in the ratio of 2:3. I have just multiplied with the selling price. The question will say the sales mix is 2:3. Some question will just say like that. If you think that sales mix is 2:3 and that 2:3 is for the value of sales, the 2:3 is for the value of sales and not the quantity of sales. The 2:3 can be for value, the 2:3 can also be for quantity. For example, how it can be for value? The question will say 1 lakh. This split in the ratio of 2:3. So V sales is 40,000 rupees and this sales is 60,000 rupees. 40,000 divided by 1,800 rupees, 60,000 divided by 2160. If the question says the sales mix is in the ratio of 2:3 and if it is rupees, then for units it's like 22 and 28 units. When it comes to units, it will become 22 units and 28 units. The sales mix given in the question can be for rupees. In this question there is no confusion. This is a general concept I am explaining. It can be for rupees, it can also be for units. It can be for rupees or it can be for units. If it is for rupees, you will use composite PVR approach. If it is for rupees, you will use the composite PVR approach. You will see this in some other question. If the mix is for units, we calculate contribution per set if this approach is followed, if sales mix is for units sold, if sales mix is for units sold. The sales mix of 2:3 in this question is for the units sold, 2:3Js, 2:3Js. When I look at from a value point of view, when I look at this from a value point of view, the mix is 36:64.8. From a value point of view, 2:3Js will mean 36:64.8, which is not 2:3, which is not 2:3. The sales mix in rupees and the sales mix in units need not match, and most of the times it will not match. Now write, we are required to find the optimal mix between alternative 1 in bracket 2V and 3J and alternative 2 1V and 2J, or whatever, I think 2 and 3 are, yeah. We are required to find the optimal mix between alternative 1 2V and 3J and alternative 2 1V and 2J, 1V and 2J. Better option would be one which leads to early break even. Better option would be one which leads to early break even. Multiple products are there in question. And we should follow below approach to get break even point. Point number A, composite PVR / weighted average PVR. This approach will be used if the sales, it's there, just write them. Point number A is composite PVR / weighted average PVR. Point number B is contribution per set. A is composite PVR / weighted average PVR. This approach is followed if the sales mix is for the amount of sales. And contribution per set, this approach is sales mix is for units sold. You will understand the sales mix in rupees later on. This question, the sales mix is for units sold. The 2:3 or 1:2 is for the quantity of sales. Quantity of sales does not mean the value of sales also will be in the same ratio. Quantity of sales does not mean the value of sales will also be in the same proportion. Any doubts till now? Clear? Okay, now write computation of BEP of alternative 1. BEP of alternative 1. Computation of BEP of alternative 1. Contribution per unit of V. Contribution per unit of V is equal to 1800 minus 900. Contribution per unit of V is equal to 1800 minus 900. Contribution per unit of J 2160 minus 1800, 360 per unit. minus 1800, 360 per unit. Okay. In my first alternative, I am planning to sell 2V and 3J. The issue for me is, in denominator, should I write 900 or 360? That's the issue I have in hand. Should I write 900 in the denominator or 360 in the denominator? Now what we are going to say is, now write, let us assume one set contains, 2 units of V and 3 units of J. 2 units of V and 3 units of J. Now what I am saying is, company does not sell V, company does not sell J. They are not selling these two products. They sell a product called as VJ. They sell a product called as a VJ. So you go to the shop, ask for VJ, he will give you 2V and 3J. One set, only as a set he is going to sell it. This is just an assumption. Basically the sales will happen in this ratio in the practical world, but our assumption is one set has 2 units of V and 3 units of J. Contribution per set is equal to 2 into 900, 2 into 900, 3 into 360, 2 into 900, 3 into 360, 3 into 360, 2880 per set, 2880 per set. Clear? Now break even point in set equal to, I am not calculating in units, I am calculating in set. Break even point in set is equal to fixed cost by contribution per set. Fixed cost by contribution per set. I don't sell V, I don't sell J, I sell them together called as VJ. I sell the product together. So we are able to calculate the combined contribution. We are able to calculate the combined contribution because we are selling it as a combined product rather than selling it as a standalone product. 88,000 by 2880, give me 2 decimal answer. 34 point 30.56 set. Practically there is nothing like 30.56 set and all. These were our assumption. This was just our assumption to make the problem simpler or to solve the question. Else I don't know in the denominator what do I take, because I have 2 numbers. I cannot take both the numbers, so I had to do something. So we took an assumption and taken this. This gets split into 2. BP of V BP of J, BP of V and BP of J, of V and J, $30.56 into 2, 30.56 into 3. I am not dividing in the ratio of 2:3. I am multiplying because one set has 2 V and 3 J. One set we assume has 2 units of V and 3 units of J. So if you are selling 30.56 set, indirectly you are selling 30.56 into 2 V's and 30.56 into 3 J. So this will be 61 units and this should be 92 units. 61 units and 92 units. Break even point of V is 61, break even point of J is 92 units. V is 61 units, J is 92 units. This also doesn't help me. This also doesn't help me. Or multiply with the selling price. 61 units into the selling price, 92 units into the selling price. 61 units into the selling price. 61 into I think 1800 was the selling price. How much? 1,09,800. 92 into 2160. 1 lakh 90. Okay. 720. Okay. 198 720. And finally I can say, add this together, break even sales of alternative 1. Break even sales of alternative 1 is, combine this together, 109,800 plus 198,720. 30. You will be able to attain break even with the sales of rupees 3,08,520. Second alternative, if it's more than 3,08,520, that's not the preferred alternative. If it's less than 3,08,520, that will become the preferred alternative. So again I am explaining, I have two products, I cannot directly do divided by 900 or 360. That's ruled out because I have two products. I wanted to calculate break even point. When you have 2, 3, 4, 5, any number of products, doesn't matter. You will calculate something called as contribution per set if the sales mix is for units. If you look at this 109,800 is to 198,720, this is not 2:3. The value is not in the ratio of 2:3. If you look at the value, the composition is not 2:3. Units is 2:3, some rounding of gap will be there. 61 is to 91.5 it will come because we had rounded this downwards, that was rounded upwards, so that gap can be there. But broadly 61 units and 92 units need to be sold. If you sell 61 units and 92 units, you will attain break even. You will attain break even. 61 units has a value of 1,09,800, 92 units has a value of 1,98,720. Overall put together values 3,08,520. Calculate break even point of alternative 2 quickly. Do BEP of alternative 2, same approach. Calculate the contribution per set, same concept you do, get to the break even point. Alternative 2. break even point is 3,32,640, 332,640. I'll obviously go ahead with alternative 1. I'll go ahead with alternative 1 because that has better break even point or a lower break even point. So it's quicker to attain break even there. Quicker to attain break even in alternative 1. No, with contribution you cannot answer because here 2880 per unit is for 5 units put together. This 1620 is for 3 units put together. So you can divide and get contribution per unit also, but that also will not help you. What can finally help you is if you calculate something called as profit volume ratio. I'll quickly come to this because you've asked it. Can you tell me 2 units of V and 3 units of J? 2 units of V and 3 units of J put together, what is the value of sales? 2 units of V and 3 units of J put together, value of sales. Value of sales. How much? 90. Okay, so PVR would be 2880 divided by 9080. This is the PVR of alternative 1. This is the PVR of alternative. You could have gone with PVR. You could have gone with the composite PVR. That could help us in getting the answer. That could have helped us in getting to know the answer. First, you will have to calculate the contribution per set divided by the overall sales. Second alternative, what is the value of sales? 1V and 2J put together. 1V and 2J put together, value of sales. How much? 6120. So this has better profitability. The second alternative has lower profitability. So net in the end, you will see the first alternative to be the better one. You will see the first alternative. In fact, the break even point of the first alternative would have been closer to this 88,000 by this number. Just give me a minute. This is matching. Is there an error? This 9080, can you check? How much? 10,000? Okay, 10,880. 10 0080. Okay, this would have been your break even point, a closer number to this. A closer number to this, we had done some rounding off and all. A closer number to this would have been the break even part. So I could have done it this way, but it's better to explain the concept of multiple break even points. So that's how I done it that way. Contribution per set, we calculated the break even point, and the break even point finally told us which is the better choice. You can write the company should go ahead with alternative 1, 2V and 3J, should go ahead with alternative 1, 2V and 3J, as the same leads to early break even. As the same leads to early break even. The challenge is we have to calculate break even point, but we have two different contribution. So if you have two different contribution, you will have to calculate contribution per set and then go ahead with solving the problem. I'll come to this 3 later because I'll have to explain indifference point. Let's come to question 4. Let's come to question 4. A Limited makes and sells a single product. Company's trading results for the year are as under. Particulars: year 2007 in thousands, sales 3,000 thousands, material 900, labor 600, overheads 900, profit 600. For 2008, following are expected: reduction in selling price, increase in quantity sold, inflation of direct material, inflation of variable overhead, reduction of fixed overhead. It is also known that in 2006, overhead expenditure total to 8 lakh. Inflation for 2007 has been 5%. Production and sales volume have been 25% higher in 2007 than in 2006. High-low method is used to estimate the overhead expenditure. Prepare a statement showing the estimated trading results, break-even point for 2007 and 2008, comment on the BEP, calculate the sales to be made to maintain the same net profit ratio, percentage increase in selling price to maintain the same net profit ratio, and sales to be made in 2008 to maintain the same net profit. Go through the question. All these are basics of break-even point. Okay, they have given the trading results for 2007. In 2008, some changes are going to happen. Selling price will reduce, quantity sold will go up, direct material will go up. Some changes are there, and some analysis of overhead data is given. We are required to prepare a statement showing the estimated trading results. Look at the question, tell me, have they told how many units are sold in 2007? Anywhere it is mentioned how many units are sold. So, I will make an assumption that 100 units are sold in 2007. 100 units are sold in 2007. This makes it simpler for me to solve the question. And each unit need 1 unit of raw material. So, 100 units means 100 kg of raw material, 100 labor hours. So, that is the assumption. That is how we will solve it. So, with that assumption, we will try to get the 2008 trading results and thereafter start answering whatever is asked in the question. Working note 1, estimated trading results for 2008. I will explain that high-low method, something is mentioned. So, I will come to that in some time. Working note 1, estimated trading results for 2008. Estimated trading results for 2008. Let us assume 100 units are sold in 2007. Let us assume 100 units are sold in 2007. Particulars, year 2007 with 2 subcolumn, per unit and total. Particulars, year 2007, per unit, total, and then 2008 per unit, total. My assumption is in 2007 we have sold 100 units. That assumption will make it simpler to solve the question. You will understand the importance of this as we proceed. Year 2007, year 2008. Sales 3,000, so 30 lakh. Sales is 30 lakhs, 3,000 thousands. Sales is 30 lakh. Divide by 100 units. We had made an assumption that 100 units are sold in 2007. 100 units are sold in 2007. So 30,000 rupees into 100. For 2008, any change in selling price given in the question? How much? Reduction of? Okay, 30,000 into 90% then. Into 90%. Into 90%, 27,000. Any change in quantity sold? Goes up by 50%, so into 150. 40 lakh 50,000. 27,000, 150 units. 2007 it was 100 units. 2008 is 150 units. 2007 100 and 2008 is 150 units. Clear? Less variable costs. Less variable costs. Sales less variable cost. Direct material. Direct material. 9 lakh is the last year number. Divide by 100, 9,000. 9 lakh and 9,000. Divided by 100. 9,000. 100 is the assumption we have made. Any unit you can take, 100 makes it simpler to do the calculation. You can even write without this assumption also. Then we would have said 30 lakh minus 10% for price plus 50% for quantity, and then you would have calculated 40 lakh 50, which will be more time consuming and sometimes it can become tricky also. Any changes in direct material? 8%. So should I do 9 lakh plus 8% or 9,000 plus 8%? 9,000 plus 8%. And this would be multiplied with 150 units. This would be multiplied with 150 units. Last year we sold 100 units, this year 150 units. 14 lakh 58,000. Direct labor. Direct labor. $9,720 into 150 I have done. 150, 100 was the last year sale, this year sale is 150. Direct labor last year is 6 lakh. Per unit is 6,000. 6 lakh and 6,000. Any changes in direct labor cost in the question? So will the same 6 lakh continue? No. It will be 6,000 continue and into 150 it will become 9 lakh. 6,000 into 150 will become 9 lakh. Direct labor 6,000, 6 lakh, 6,000 and 9 lakh. Now comes the tricky part. Variable overhead, contribution, less fixed overhead and profit. Variable overhead, contribution, less fixed overhead and profit. The problem is the overhead is 9 lakh. I don't know how much is variable, how much is fixed. I cannot make assumption and all because both are there. If the question had not mentioned something like this, I could have said this overhead is variable or this overhead is fixed and tried to solve the question. But the question clearly mentioned that there is a price inflation in variable overhead, there is a reduction in fixed overhead. On top of that, they said you use the high-low method to estimate the overhead expenditure. What is this high-low method? I will explain. Now listen. 2007, you can write this in some time. 2007, 100 units, 9 lakh rupees. 100 units, 9 lakh rupees. Okay. 2006, read the question carefully. using this line, can you tell me how many units will be in 2006? Read this line carefully and tell me the number of units in 2006. 2007 is 100 units. What should be 2006 production? It will be 80, not 75. You cannot subtract 25%. What they have said is 2007 is 25% higher than 2006. So 2007 is equal to 125% of 2006. 2007 is 125% of 2006. So 100 is equal to 125% of 2006, and 2006 volume is 100 divided by 125%, 80. On this 80 add 25%, you will get 100. On this 80 add 25%, you will get 100. 80 units, how much is the expenditure? Assume now 2007 100 units 9 lakh, 2006 80 units 8 lakh. This is the scenario. In 2007, the issue is this 9 lakh and 8 lakh are not comparable numbers. 9 lakh and 8 lakh are not comparable numbers. Why are they not comparable? Is somewhere the question talks about some inflation. I'll come to it in some time. But 9 lakh and 8 lakh are not comparable. If these two were comparable, then you have an approach called as variable cost per unit is equal to change in cost by change in units. You could have come across this at inter level. Change in the cost 9 lakh minus 8 lakh divided by 100 minus 80 will give you the variable overhead per unit. Balance will be fixed overhead. But 9 lakh and 8 lakh are not comparable. Reason why they are not comparable is there is a inflation in 2007. There is an inflation in 2007. Total overhead cost inflation for 2007 has been 5% more than 2006. So 2007 100 units 9 lakh, 2006 80 units 8 lakh. 2007 if same 80 had continued, 2007 if same 80 had continued, logically you will have the same 8 lakh. If 80 continues, logically you should have the same 8 lakh, because you will not incur any extra fixed overhead, no extra variable overhead, because volume has not gone up. But there is inflation of how much? 5%. So this 8 lakh would have become 8 lakh 40. I am not giving effect to the units change now. Why did it become 9 lakh is because you have sold more units. Why did it become 9 lakh is because you have sold more units. When you produce more units, your variable overhead will go up. Total variable overhead will go up, because variable overheads is directly proportional to volume. So 2007 100 units 9 lakh, 2006 80 units 8 lakh. 2007 if the same 80 units had continued, the cost would have been 8 lakh 40. Ignore this, okay, because this is not useful for me. This is not useful for me because this does not have inflation. This does not have inflation. The other two has inflation. You can compare only items which includes the inflation aspect. So 2006 did not have inflation. What I can do is from 2007 I can remove inflation if I want. I can remove inflation and get, but that will come in decimals, and then you will have to finally again add back inflation. Why you need to add back inflation? Because we are working 2007 data. Finally I need the 2007 number. So there is no point in removing inflation from 2007. I can add inflation to 2006. 2006 8 lakh does not have 5% inflation. So I added that inflation and I am writing 2007 if you produce 80 units, or indirectly this is unadjusted overheads and this is called adjusted overheads. This is called adjusted overheads, adjusted for inflation. Adjusted for inflation. Now listen, variable overhead per unit is equal to change in cost by change in units, which is 9 lakh minus 8 lakh 40 divided by 100 minus 80, 3000 per unit. This 3000 either you substitute in 2007 9 lakh figure or you substitute in 2007 8 lakh 40 figure. Any of them you will get the fixed cost. You will get the fixed cost. Either substitute in the 100 unit data or substitute in the 80 units data. Don't try to substitute in the 2006 80 unit. There you will not get the number because that doesn't have inflation. That doesn't have inflation. I'll give you time to write. Now let me take 2007 9 lakh number split into total variable cost, total fixed cost. Total variable cost is 3000 into 100, 3 lakh. Total fixed cost balancing figure 6 lakh. Total fixed cost balancing figure is 6 lakh. Once this breakup is in, I will be able to complete the trading statement. I will be able to complete the estimated trading result. I will explain again. 2700 units, 9 lakh rupees, which is given in the question. 2006, the volume of 2007 is 25% more than 2006. So it is 80 units here, 100 divided by 125%. 80 units, amount is 8 lakh. Problem is this 8 lakh is a useless number because it does not include inflation. It does not include inflation. So I added the inflation aspect and made 80 units as 8 lakh 40. Made 80 units as 8 lakh 40. You would have come across a formula called as variable cost per unit is equal to change in total cost by change in units. You have learnt at inter level. If not, you kind of again learn it here. Change in total cost by change in units if you have forgotten it. So variable overhead is 3000 per unit. Fixed overhead you can substitute either in 8 lakh 40 or in 9 lakh. Both places if you substitute you will get 6 lakh only answer. If you substitute in 8 lakh 40, 80 into 3000 is 2 lakh 40. Balance 6 lakh is fixed cost. Balance 6 lakh is fixed cost. Now write this. Note 1 analysis of overhead. Note 1 analysis of overhead. (2007) 100 units equal to 9 lakh. 2007 100 units equal to 9 lakh. (2006) 80 units equal to 8 lakh. 80 units equal to 8 lakh. Then 2007 80 units is equal to 8 lakh plus 5% inflation. 8 lakh plus 5% inflation. If the same 80 units continue, 8 lakh plus 5% inflation, 8 lakh 40. 8 lakh 40. Clear? Now variable overhead per unit is equal to change in cost by change in units. Change in cost by change in units. (9 lakh minus 8 lakh 40) divide by 100 minus 80. 3000 per unit, and then split that 9 lakh into 2. Detailed explanation on this is there in the printed solution, that writing those points, let's not worry about writing down those points and all. Understand the calculation which I am trying to explain here. Total variable cost is 3000 into 100, 3 lakh. Total fixed cost balancing figure is 6 lakh. We could have even substituted this at 8 lakh 40, would have got the same numbers. If this inflation issue was not there between 2006 and 2007, then simply I would have done 9 lakh minus 8 lakh divided by 100 minus 80. 9 lakh minus 8 lakh divided by 100 minus 80. Now coming to this part, 3000 3 lakh, 3000 and 3 lakh, 6 lakh, and profit I think was 6 lakh. Yeah, 3000. I have not written fixed overhead per unit. I don't want that number. Per unit is anyway of no use. Fixed overhead per unit is of no use. 3,000 3 lakh, contribution 12 lakh, fixed overhead is 6 lakh, profit is 6 lakh. Any change in variable overhead in the question? How much is the inflation? 6%. So any change in variable overhead represents the change in variable overhead per unit. Any change in variable overhead represents a change in variable overhead per unit into 1.06 and then into 150 units and then into 150 units. $150 units. $3,000 will become 3,180, extra 6%, increase of 6%. 3,000 becomes 3,180 into 150 on top of that. Any change in fixed overhead? Reduction by 25%, so into 75%. 12, 15, 450 and 765. 4,50,000 is the fixed overhead. Profit is 7,65,000. Clear? Now, for answering the balance requirement of the question, please ignore this per unit. All this was your assumption. So don't try to write BP in units, MOS in units. All that is not possible because we just made an assumption of 100 units. So whatever answer I'm going to do beyond this, let's not look into per unit number. Let's not look into the per unit data. That per unit was just our assumption to make the problem simpler. Else I would have worked with percentages. It could have become little complicated for few of you. So that is why I did not want to do with percentages. I made that per unit assumption. So the answer will have this, but let's not look into the per unit numbers. Don't look at the per unit numbers now onwards. Let's look at the requirement. Prepare a statement showing the estimated trading results for 2008. We are done with that. BEP of 2007 and 2008 only in rupees will calculate. Only in rupees. Don't try to calculate in units because that will not be the right way of doing it. Now, break even point. BP is equal to fixed cost by PVR. Fixed cost by PVR. PVR of 2007 is equal to contribution by sales. 12 lakh by 30 lakh. %. PVR of 2007, 12 lakh by 30 lakh. 12 lakhs divided by 30 lakhs, 40%. PVR of 2007, 12 lakhs divided by 30 lakhs, 40%. PVR of 2008, PVR of 2008, I am not looking at the per unit number itself, 12 lakh 15 by 40 lakh 50,000 into 100, 12 lakh 15 by 40 lakh 50,000 into 100. %, 40% and 30%. PVR 40% and 30%. You know the fixed cost, you will calculate the break even point. 40 and 30. 6 lakh by 40%, 4 lakh 50 by 30%. Coincidence, both are same. Reason is in 2007 your PVR was good, fixed cost was higher. In 2008 fixed cost came down, but that is offset by fall in PVR. Fixed cost came down by 25%. PVR also from 40%, it has come down by 25% of 40%. 25% of 40%, which is 10%. So PVR also came down by 25%. PVR is 40. From 40 it has come down by 25%. So it became 30. Fixed cost from 6 lakh has come down by 25%. So kind of your break even point has remained same. So you can look at that comment in the solution itself. Comment on the BEP and the profits. The BEP has remained same. The reason for it remaining same is your fall in fixed cost has been offset by the fall in PVR. Fall in fixed cost has been offset by the benefit of lower fixed cost is not realized because PVR has come down. PVR has come down. Calculate the sales to be made in 2008 to maintain the same net profit ratio. Let's do this now. Particulars, same net profit ratio. You can have space. I may open extra columns later on, okay. There are three situations. First I'll do the same net profit ratio, then I think same net profit, and there's one more situation there. Same net profit ratio. Same net profit ratio, then I'll do same net profit, and then finally I think there is some on the selling price side. Particular same NP ratio. I don't have the selling price in the question, so I cannot say unit sold is X because I don't know what to multiply with. I don't know what to multiply with. So sales itself is X. Sales itself is X. I don't know the unit sold and the selling price breakup in this question. So unit sold and selling price put together, sales itself is X. Sales is X. Sales is X. In 2008, what is the PVR we calculated? Which means variable cost is 70%, contribution is 30%. Variable cost is 70%, contribution is 30%. Variable cost is 70% of sales, contribution is 30% of sales. Fixed cost is 4,50,000. Fixed cost is 4,50,000. Can you tell me what is the net profit ratio of 2007? Net profit ratio of 2007. $6 lakh divided by 30 lakh, 20%. Now listen, 0.3x minus 4,50,000 is equal to 20% of X. 20% of sales, 20% of X. You get the answer to X, that's the amount of sales. That's the amount of sales to be done. 0.3x minus 4,50,000 is equal to 20% of X. X is the sales. 20% of X. Sales is equal to 45 lakhs. So if I do a sales of 45 lakh rupees, I'll be able to maintain the same net profit margin. We did a sales of 40 lakh 50, so we could not maintain the same NP margin. They wanted us to maintain the same net profit margin. Clear? I'll come to percentage increase later on. Next, last situation we'll do, same net profit, same net profit, same net profit. There's something on selling price, I'll do that in the end. Same net profit, it will be exactly same, x 0.7x, 0.3x, 450, 0.3x minus 450. Sales will be x, variable cost will be 0.7x, contribution will be 0.3x, fixed cost will be 4,50,000. Now the objective is to maintain the net profit, not the net profit ratio. So net profit of last year was how much? So I am equating this to 6 lakh, you can let me know the sales. 35 lakhs. One situation I wanted to maintain the profit margin, so I equated to 20% of sales. Another situation I want to maintain the same profit, so I have equated it to 6 lakh rupees. I could have done this even by using a formula called as sales to achieve desired profit. Desired profit is 6 lakh plus fixed cost of 4,50,000 by PVR would have given me the answer. Any doubts on this? Then calculate the percentage increase in selling price to maintain the same NP ratio. Now listen for some time, this is the trickiest part. Same NP ratio. The question is very clear, percentage increase in selling price, percentage increase in selling price. To give an example, this was 27,000 into 150. This was 27,000 into 150. I'll have to go back to this example, then only you'll understand it better. Now what will happen is this 27,000 can become 28, 29, 30, 31, 32. I don't know the number, but it can go up. It can go up. Into the units will remain same 150. The value of sales will go up. The value of sales will go up. 150 and all I cannot take because 150 was my assumption. I cannot work with 150 and say 150 into the selling price sales. That will not work. Why I come to this example is your variable cost will be put together 28 lakh 35,000. That's the addition of these three items. It will be 28 lakh 35,000. This will not change. This will not change. Why will this not change? Because what you are changing is the selling price and not the volume. If volume changes, overall variable cost will change. If volume does not change and only the selling price changes, this will change. Will the PVR remain same now? Would the profit volume ratio remain same? No, it's not going to remain same because you are increasing the selling price. So now listen, this is X, this is X. Variable cost is not 0.7x, variable cost is not 0.7x because once you increase the selling price, the PVR will not be 30%. If PVR is not 30%, variable cost cannot be 70%. So your variable cost is going to be 28 lakh 35,000. Variable cost is going to be 28 lakh 35,000. Wait, listen for some time. This is going to be X minus 28 lakh 35,000. Fixed cost is 4 lakh 50,000. Fixed cost is 4 lakh 50,000 and this is X minus 32 lakh 85,000. X minus 32 lakh 85,000. Why did I assume sales as X is? Because I don't know the selling price. The units will remain same, but I don't know the selling price. So selling price into the number of units, what it will be, I don't know. Should be equal to 20% of X. Should be equal to 20% of X. Wait for some time. You will get an answer which will be more than 40 lakh 50. You will get an answer which will be more than 40 lakh 50. Whatever that extra amount is coming, no, that is the percentage increase in selling price. That is the percentage increase in selling price because there needs to be a increase in the selling price and I want to maintain the same net profit margin. PVR will undergo a change. I am making it very clear. PVR is not going to be 30%. That will go up. That will go up because selling price is increasing. So this is X Variable cost will continue to be 20. Understand the difference between same net profit ratio units changing and same net profit ratio selling price changing. When units change, I took 0.7x. Why did I take 0.7x? Is because it was very clear. If units change, then your variable cost will also go up or come down with the sales. Here sales will go up, but variable cost will not go up. Variable cost will not go up. So same 28 lakh 35,000, x minus 2835 minus 450. Equate this and let me know the x. Do this and let me know the x. 41 lakh 6,250. Do it. Take your time and complete it. Now that 40 lakh 50 was there, it is becoming 41,06,250 only because of increase in selling price. It is going up only because of increase in selling price. The volume technically continues to be 150. 150 was our assumption, but technically I don't know the volume. It continues to be the same. Whatever was the volume, 150 was an assumption to make the problem simpler. Any doubts on 41,06,250? If you look at now, technically what will happen is, the PVR is this number. I subtracted the variable cost. PVR is now some 31%. PVR is technically around 31% now. I need not calculate PVR and all, just for your understanding, because we are changing the selling price. PVR will undergo a change. Percentage increase in selling price. Percentage increase in selling price is equal to new sales 41 lakh 6,250 minus old sales 40 lakh 50. This increase is because of selling price. Whatever increase is happening is because of selling price divided by 40 lakh 50 into 100. How much? 1.39. So I'll increase the selling price by 1.39% technically. The selling price will go up by 1.39%. This will ensure my net profit margin continues to be 20%. My net profit margin continues to be 20%. They could have made this question saying that percentage increase in selling price to maintain the same. In this question, it's technically percentage decrease in selling price to maintain the same net profit. They could have mentioned same net profit here as well. Clear? Any doubts on this? Net profit ratio and profit per unit is same. If the question says you want to maintain same profit per unit and you want to maintain same net profit ratio, technically both are same, because net profit ratio is profit by sales and this is profit per unit as it is. So both are technically same. So sometimes question will say maintain net profit ratio, sometimes question will say maintain net profit, sometimes question will say maintain net profit per unit. It can be maintained by changing the selling price or by changing the quantity sold. By changing the selling price or by changing the quantity sold. It will be quantity sold if problem is silent. Till now all problems, the earlier question also, this question we did quantity sold. When question specifically tells selling price, you will have to follow the selling price part. Clear? Any doubts on this? Okay, with this I'm kind of done. Tomorrow I'll be sending a test paper on relevant costing. So do whatever preparation you want to do, complete it today. Tomorrow you'll get the paper. Expectation is tomorrow by end of day you complete the paper. You will have to write the test tomorrow, whatever time convenient for you. But tomorrow you will have to write the test at home. Somebody else corrects your paper or you do your own evaluation, whatever is comfortable. Question paper will come mostly in the morning. I should send the answer key by, or I'll send the question paper by today end of day, by around 8 PM. Somebody wants to write in the evening, you can write it after whatever time works well for you. The question paper would be given, the answer key would also be given after a day. If you have not been able to write it in a day's time, I wouldn't want that option, but in case because of some extra commitment, don't look at the answer key, write the test and then look at the answer key later on. Okay, we'll end with this then.